This is David Hillier here, and I'm going to be giving a short video, in this particular case, looking at a capital budgeting decision. Now, the capital budgeting case study that I'm considering is from my textbooks, and I would really strongly encourage you to have the textbook next to you while I go through this example. It's very difficult when you have a video and you have the spreadsheets, you have the slides to then fit in the actual document itself. So it will need both the book and the spreadsheet in front of you. This is complex, but I'm going to try and break it down into four stages. And I probably in the way that I explain it in the book, is probably a bit more complex than what I'm doing here. And so this might give you a little bit of comfort that you can attempt these types of questions with, some confidence. So without further ado, we'll look at the case. And the case is from section 7.2. It's of the book Corporate Finance, and it's Wearballs Limited. Now, this is a company that has already been producing a wide range of sporting equipment. It's got very good marketing, and they're looking into a new product, which is multicoloured bowling balls. In this in this particular case, the company has undertaken a marketing survey in three different areas. They've had very good feedback, and they think that the this bowling ball model that they're wanting to produce could take up to 15% market share. It cost a £250,000 to undertake this survey, but on the basis of the survey, it was felt that yeah, you could go forward with the next stage of the analysis, which is what we're going to do just now. So I discuss all of this in the book. What I've done here is I've basically just focused on the main points that come out of the book. In any type of capital budgeting analysis, you have to separate the wood from the trees. You will be bombarded in practice with so much information that it's actually a real task to separate what's important and what's not important. And that's why my previous video that's looking at the different types of cash flows that you should include in an analysis is so important. So let's just look at some of the real core inputs here. First of all, the balls uh, could be manufactured in a building which is currently vacant. Now, you could sell that building just now for 150k after taxes, so it's taking the tax part out. It's the net of tax figure. So if you undertake this project, you're not going to be able to sell the building, which means that it's an opportunity cost. You have to buy a machine, and the machine cost is 100k. And at the end of the 5 years of this project, the estimated market value is going to be 30k. So we're going to have a bit of a situation with the depreciation estimate and how we can try and marry that up with the actual end of project market value. The project's going to run for 5 years, and you in the third box here, you can see that the year by year units sold, they go up and then it falls away. So that's to represent capturing market income growth, but then competitors coming in and stealing your business. We're going to start off with the price being £20, but that's going to increase at 2% per year. And we also have inflation of 5% per year. The cash outflows are expected to grow at 10%, and that's the direct costs of the project. And the first year cost will be £10 per unit. We're told that the corporate tax rate is 28%, and we're going to be using 25% reducing balance for our depreciation. We have some investment here in working capital, That starts off at 10,000. It's going to rise in the early years, but then it's going to fall. And in the textbook, I've actually set it out and laid it out. But I will come to that part when I'm going to be working on the spreadsheet. So we'll keep this slide on screen, and I'll try and fit everything in on this spreadsheet here. So stage one of any capital budgeting analysis is to calculate the depreciation. If it's straight line, it's very simple. You just take the number of years that you use the asset and then divide the initial investment by the number of years that is depreciated over. But with reducing balance, it's just slightly different. And the best thing to do is just take you through it step by step. So we'll have the initial value, we have the depreciation, and then you have the residual value. I'll just put residual because of the space. We have 5 years. The initial value of the estimate of the machine is 100k. So let's put in 100,000 here. Depreciation is 25%. So 25% of 100,000 is 25. So the residual value at the end of year one is 75,000. Now that residual value for year one is the initial value for year two. And the depreciation is 25% of the initial value. We've got here it's 18,750. And we do the same thing. We work out the residual value in year two, and we have that as 56,250. Now I can then copy this all the way down. And what we're doing is we're just taking 25% of the initial value. In the last year, we have to just do something slightly different. We know that the product is selling for 30k, so we put the residual value as 30k here, and it means that our depreciation is simply the difference between the initial value for the year and the residual value. And that in here it's 1640. That's a slightly different method to what I use in the book. What I do in the book is I take the residual value to be 25% of this. This is in table 7.1 in corporate finance. And then there is a profit on the sale of the machine. But you can bypass that stage by just putting the market value, the end of project market value at the end of the project, and then just calculate a depreciation, which is just the difference between the initial value and the residual, which is this figure here. I think that's simpler, and in a future edition of my books, I think I'm going to go to this method. So what we have here is we have an annual depreciation. The next thing we need to do is work out what our direct revenues are and our costs are. I'm going to have to move this window over somewhat just to try and fit everything in, but I'll see if I can get away with it. So we start off with the year, and there's 5 years of the project. We find how much is produced. We'll put Q for that, and that is 5,000. You can see here, and that's in the third slide at the top. It's this one here. 12,000, 10,000, and 6,000. That's Q. What's the price? We'll put P here. Well, the price starts off at £20, and it grows by 2% a year. So the year two price is equal to 20 times 1.02, and we can just copy that down all the way down. So the year 5 price is 21.65. So what's the revenue then? Revenue is equal to the quantity produced times the price. So the revenue is equal to 100k, and we just copy that down directly. Now I'm going to just move this along here so that we can fit in the cost. We'll put a C for cost, and that's the unit cost. Now we're told that the unit cost is £10 to start off, and that is going to grow at 10% per year. So it's 10 multiplied by 1.1, which is 11, and we can copy that down, and we can get the unit costs per year. So what's the operating cost then? So I'll put just OC for operating cost, and the operating cost is just the cost of production multiplied by the number of units. And copying this down, I'm going to just justify everything just so that it looks nice. And that's our operating revenues and costs. These are our operating revenues, and these are our operating costs. Now we're going to now go into the next stage, okay? And the next stage is, and it's a continuation of this stage, is to calculate the income statement for this particular project. So stage 2 is the income statement. Now the reason why we use the income statement is that we want to calculate tax. Tax is a cash flow, income isn't. So, as I've said in the previous video, don't bother with the actual earnings figures because it's not real cash flow. But what is important is that the accounting process leads to a particular tax payment. And with that, we do need to include that in our analysis. We're also so we're going to use these tables here and the figures that we've already calculated, and we'll put in. So we've got 5 years for the project. We'll start off with revenues. What's our revenues? Our revenues are these figures here. So the way I've set out the spreadsheet is I need to do this one by one, which is a bit of a pain, but um, it's just in terms of fitting everything into the one spreadsheet. That's probably the best way to do that. Now, what's the operating costs? Our operating costs are these ones here. So it's equal to 50, 88, 145, 133, and 87. So that's our operating cost. We also need to include depreciation. And our depreciation comes from these figures here. So it's not great, but I'm going to have to move up and down the spreadsheet. The year 2 depreciation, year 3, 4, and 5. So that's our depreciation. And we now in the book I also have profit on the sale of the machine, but because I had included that component here, it means we don't need to bother with that. So this is a slightly different approach to that in the book, but I probably like this better, this approach. So earnings before taxes, we have the revenues minus the operating costs minus the depreciation. We can copy that along, and from there we then can calculate the tax at 28%. Why is it 28%? You've got it here. So tax at 28%. So 28% of the EBT is 7k. And we then can get the net income. So the net income is just the earnings before tax minus the tax. And that's us got the earnings statement. And although we approached the way we dealt with the sale of the machine, you'll notice that these figures here are the same as the net income in the book. So we just went 2 different directions to go here, but I like this method. The next part that we've got to do is we need to start thinking about the investment And we can put that in the stage two. Now, in the book, I actually tell you what the net working capital should be. So what we'll do is we'll have our actual net working capital is over 5 years. Notice I've got year zero here. Now, the reason why we have zero, I'm just putting NWC for net working capital, is that an assumption of capital budgeting analysis is that before you actually start operations, you have to buy raw materials. So buying raw materials, it needs to take place at the very beginning. And so therefore we have a figure for net working capital in year zero. And for that, it's 10,000. Now we say that there's no change in the net working capital, so it stays at 10,000, but then it goes up to 16,320, and then it goes up to 24,970. In year four, it starts to come down 21,220, and then in year five, at the end of the project, you assume that you basically just sell off all your inventory and anything to do with the project. So you basically reduce your net working capital to zero. But that's net working capital is, think about it as inventory, but it's not cash flow, and it's cash flow that we are interested in. So to work out what the annual cash flow should be, you have to think about, well, if you're going to buy inventory, you've got a cash outflow. If you sell inventory, you've got a cash inflow. So we need to look at the change in inventory, and if the inventory or the net working capital goes up, it's a cash outflow. If the net working capital goes down, it's a cash inflow. So change in net working capital, well, clearly we've got an increase, so it's a cash outflow, and I'm going to just put it as a negative just so that we remember that's the case. There's no change in net working capital between time 0 and 1, so we have no change, and that's a 0 there. The inventory then goes up from 1 to 2, and so we have to think, well, what is the change in net working capital? Well, it's equal to the 16,320 minus the value before. And what I'm going to do is I'm just going to put a minus sign there, again, just to make sure that we are representing an outflow in cash as a minus. We then, it goes up again, so we find the difference. It's another cash outflow because we're growing the inventory, but then in years 4 and 5 it starts to go down. So we need to do, it's the same formula. It's just the 21k minus the 24k, and I put a minus sign in front of the brackets, so it means that we've got a cash inflow. And then in the final year, it goes from 21k down to 0, and that means that we've got a cash inflow of 21k, and that is the cash flows resulting from the inventory or the change in the net working capital. Stage 3 on this is to look at the actual cash flows themselves. And I'm going to work out two separate areas. I'm going to look at the cash flow from operations and then the cash flow from investment. So it's a similar type of concept to what we do in accounting, where we get the total cash flow as the cash flow from operations, the cash flow from investing activities, and the cash flow from financing activities. And that's what we're going to do in this. So let's talk about the cash flow from operations. Cash flow from ops. Right, okay. We're going to start off at time 0, and we're going to say, and this is I think that's, yeah, I'll copy this down just once so that we can have, in fact, what we'll do is I'll bring this right up. So we've got 0, 1, 2, 3, 4, 5. So the cash flow from ops, let's start off with that one. To get the cash flow from the operations, we begin with net income. And our net income figure is, I know that it starts in year 1, but so let's go up. What is our net income? In year 1, our net income is here. So this is what we're going to start off with. We can copy that along. So that's our net income figure. And we're then going to add in depreciation. We're going to add depreciation back. Now, why? Because if you look at this income statement, the only adjustment here that results from a non-cash flow item, an accounting item in this case, is depreciation. Everything else is cash. So what I'm going to do is I'm just going to add depreciation back in. So we'll just put that here, copy this along because that's our annual depreciation. So our net cash flow from ops is simply the net income plus the depreciation. And that is our net cash flow from our operations. We now want to, let me just write that, cash flow from operations, just to make it nicer. We're now going to cash flow from investments. And this is where I spelled investment wrong. This is where we now add in all those cash flows that are not linked to operations, but are actually linked to the investments. Now, let's go through each of these, and this is where I need to go back to this. First of all, we bought the bowling ball machine. So let's just say the machine. Let's just write machine. How much did it cost? It cost us 100k. So I'm going to put 100,000 here. And remember, we're dealing in cash flows here. So we sell it in 30 years, 5 years, for 30k. So that's the cash flows that are resulting from the machine. Now notice any of the profits or any of the tax implications have already been included in the cash flow from operations. The next thing is we need to think about this opportunity cost. If we undertake this project, we're going to miss out on 150k at time zero, but we can then sell the building in 5 years' time for 150k. So let's just put opportunity cost warehouse. We lose out on the building at time zero, but we can sell it at time 5. So I'm going to put the 150k there. So that represents the opportunity cost. That represents when we can actually sell the warehouse. We have our change in working capital, net working capital, which is given at the very top, and I can just copy this along. So that gives us our net cash flow from investment. We have to sum these. And then copy that along to the end of the project. So you can see here that it's negative, and then towards the end of the project in years 4 and 5 we get positive. So what is the total cash flow then? What is the net cash flow? Well, the net cash flow is the sum of the cash flow from investment and the cash flow from operations. And I can just copy that along. So we have 43, we have 53, we have 70, we have 636, and then we have 23916. And that's the net cash flow. We have completed now stage 3, so we're now just going to move into stage 4. Stage 4 is the actual investment appraisal. So let's we're going to assume a discount rate of 10%. We will go through each of the different methods then. So let's start off with NPV. In NPV, we can find the present values. In fact, let's just do that up here. I can use a number of different methods. The present value is the net cash flow divided by 1 plus the discount rate to the power t. And I'm putting there's the t there. So that's our present value. We can copy that over directly because I made an absolute sale reference for the discount rate. So the NPV is just the sum of the present values. So we're given a value of 63,461, so it's positive at a discount rate of 10%. We could have used the Excel formula. If I do the Excel formula, slightly different. We have to put the rate here, comma, and now this is where this function is really annoying. You have to do a kind of two-stage part. The NPV this function only wants you to put the future cash flows in, and then you've just got to add the initial cash flow to this, and that gives you the full NPV. I have absolutely no idea why Excel or Microsoft asks us to do this. I think it could be done better, but anyway, that's what we've got, and clearly the formula is formatted differently. You can see that you get the exact same value. Internal rate of return. Internal rate of return, we can do it by trial and error. I've shown you how to do that before. But what I'm going to do is to speed up time, I'm just going to use the Excel function. And we're given a value of 17%. I'm going to, if I increase the size of this window, I can then just put this to, and it comes out at 16.92%. Right, okay. So we've got the internal rate of return, we've got the NPV. We can use any other methods. We can use profitability index, we can use payback period using the methods that we used before. But what I want to do in this video is just to show you the 4 stages of capital budgeting analysis. These questions can seem incredibly complex, but if you break it down to 4 stages, and we go through these: depreciation, income statement, cash flows, appraisal. Just follow those 4 statements. You will be able to complete any type of complex capital budgeting problem. Where the real difficulty comes in practice is in the identification of the cash flows, and that's what I covered in a previous video. That is the real problem in practice. This process here is actually fairly mechanical. It's not that much of a real difficult thing to do. So hopefully this video has made a complex issue seem a bit more simple. I hope. And I'll see you in future videos. Thank you very much.